want to have fun. Of course, most of them would kind of like to see their 401ks go up, too, you know. Advisory services offered through Second Half Financial Partners, LLC, an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments are appropriate for you, please consult with a financial advisor. Second Half Financial Partners, LLC does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation. You want to do that, especially as volatile as things are lately. It's time to check in and see what is going on Wall Street this morning with the resources of Phillip Statler from Statler Financial Services in downtown Sebring. Phillip, good morning. How do this morning?
Hey, good morning, Dave. Doing well today, but I'm afraid that after pulling out a slight green ink yesterday, I'm just not so sure we're going to be able to follow through today.
Yeah, my sneaking hunch is, and I don't even have green ink from yesterday at this point in time, but just kind of a mediocre day. And I guess the simple way is it looks like investors are finally sobering up and saying there's a bunch of stuff on the horizon we're not going to like. Dow ended up closing the day yesterday down 115 points. I got the Standard & Poor's down 23 and NASDAQ down 73. Did the Russell pull out anything positive? I think they did, didn't they?
They did pull out a whole $1.15.
Boy, am I impressed by that. And it's finally some chickens coming home to roost. Number one, we're still concerned about tariffs and the threat that we're going to start telling countries that didn't come hat in hand to take their tariffs and let's quintuple them just for giggles. That's always a possibility. The other thing going on is, oh my Lord, are the interest rates going up? News hit yesterday that we had the mortgage rates now topping up past 7%. They actually settled a little bit short of that, but still scary high mortgages. And which one? The 30-year bond hit 5%, you said?
Yes, sir. Right now it's at 5.02%.
Yeah, and this is all a negative reaction as much as anything to Moody's climbing on board with the other two rating services and dropping us down one notch from the absolute top of the line bonds, and that's going to scare everybody. We're going to end up getting the origination rate for bonds today, and the bond market watchers are just absolutely having kittens over this. The federal government is going to try to auction off a bunch of 20-year federal bonds. We were talking before we went on the air. I remember it was about 20 years ago. We had one of the downgrades hit us, and that they brought back up again a little later on. But right after that downgrade, the Fed trying to auction off a bunch of bonds, and basically nobody showed up, which ended up kicking the interest rate way up because nobody wanted to buy our bonds. Is that kind of the nightmare for today with the 20-year auction?
We shall see what happens today, Dave, because I'm just not so sure. It's going to be interesting to see who shows up and what those yields go for.
Yeah, it's because that becomes the reference right now for the sake of just clarifying for lay people. When we talk about the yield on bonds, that's based upon how much you resell them for. If you loan the federal government $100 and all of a sudden that bond needs to have a higher yield, when you sell it, that $100 bond suddenly gets sold for $99 or something. Well, that's the resale market. This time it'll be the reference rate on that federal bond, the money that the federal government has to pay in interest on what we borrow, and it's a lot. The interest that we have to pay from the get-go. So if it goes up considerably, that's going to really not be good news at all for the markets or for the government budgeting process.
Well, that's right. And we're talking about a bill right now working its way through Congress that would, again, add trillions of dollars to our deficit. I'm just not so sure I like the idea of front-loading tax cuts and rear end the deficit reduction. I mean, it sounds good, it feels good, but I'm just not so sure that that's really in our best interest.
Yeah, this is just classic legislative shell games. Some of the cuts, some of the streamlining, depending upon how you look at it, in the Medicaid program. Yep, they've got it in the bill. It looks really, really good, except it doesn't start until 2029. And extending the tax cuts that are kind of non-negotiable to the Republicans and to President Trump, they've got those continuing immediately. But, oh, my God, look at all that we cut, except it's after everybody's already out of office that the cuts actually take place. It's the reason why I've always said politically I'm impatient with both sides of the political fence.
That's right. I mean, let's make some some real dents in the deficit by let's move some of those cost cutting things up faster so that we get the benefit of them now, as well as middle class families still keeping that tax deduction or that lower tax rate. So to me, that's important that we try to start reducing the deficit now and on day one, really.
Absolutely. And to be clear, neither one of us are necessarily climbing on board with any of the social policies they're talking about, like cutting Medicaid or anything. But bottom line is, right now we owe more money than we're worth. By definition, our federal debt is above our gross domestic product. That's called bankrupt. Something has to be done. And when you start borrowing $2 trillion more than you take in every single year, we're not making any progress chopping it back by 10% by fiddling around the margins.
No, they don't let you and I do that. I mean, we'd be, having really a lot of fun
Why?
right now if they let us do that.
Why don't they, by the way? But bottom line is, it's going, whether one likes it or not, it's going to take a hatchet, even though Elon Musk might have been theatrical to the point of being offensive. Bottom line is, it is going to take a hatchet in order to get things down to the point where our income and our expenses actually wave at each other, and it's not the kind of cuts that you can make by just fiddling around the margins. So talking about the 20-year, it's going to be interesting to watch one of the tip sheets I've got called it Must-See TV for Financial Geeks. Other stuff going on, the downgrade is rippling through the bond market as mentioned. Elon Musk says he's going to do a lot less political spending in the future, and that's making the board of directors at Tesla breathe a little easier, I'd imagine.
Well, but it's making the Republicans that are coming up for re-election sweat a few more bullets because that's some money out of their coffers.
Yeah, he's kind of become the sugar daddy that the Democrats have, and that Greek fellow. I'm having brain flatulence. The Greek fellow that gets all the blame for doing everything on the Democratic side. That's
George
it.
Soros. Yeah, yeah.
That's it. Yeah, he's kind of become the George Soros to the Republicans, and if he decides to cut back, it's not what they had in mind. Still earnings season going on. We heard Home Depot a little earlier this week, and they had a pretty decent quarter. Did Lowe's manage to one-up them and look even better?
So Lowe's came out and really had a decent quarter when it came to earnings. They reported $2.92 versus $2.88 that was expected. Revenue was just a little shy of expectations. They also reaffirmed their full year guidance and their forecast. So they're trading up about 1.6% this morning.
That's interesting. Both they and Home Depot think they can keep the guidance going, even with the amount of imports they got coming in. That's intriguing.
Yeah, it is. I mean, I saw a little headline this morning about Canadian lumber and what that's going to do to home builders.
Absolutely. It's one of the primary things that we're going to be tariffing. So I'm intrigued. I'm glad to hear the news, but I'm intrigued. Bunch of other household names reporting too, aren't they?
They are. We a big retailer called Target. They reported, and I got to say, Dave, not so good for them. They missed on same store sales significantly, much less than expected. Their revenue or the earnings per share. Now the report says they're not sure if this is comparable to what the expectation was because it was adjusted. So they had $1.30 adjusted. The expectation was for $1.61. I'm not sure if those are actually comparable numbers. They haven't dug deep enough to really figure that out yet. But still, not as I mean, just the same store sales deal is a big KPI that really caused the stock to start to fall. Revenue, they big miss on revenue. They had 23.8 billion versus 24.7 billion that was expected. So you can guess that Target's not doing well this morning, down 6.25%.
I'm starting to get the feeling that anybody trying to fit in the middle in there between the luxury department stores and the pure discounters like Walmart, they all seem to be getting into trouble lately. First, we've watched Kohl's basically auger in, and now we're looking at Target starting to have difficulties. A middle position doesn't seem to work very well when you're in economic stress.
Yeah, it doesn't. And here's what they blame. They blame the tariff uncertainty and the backlash they seem to be getting from DEI rollbacks, um, which, somebody else in the article said, they got to get back to that Tarzay, where they're in that line of where people want to come buy their stuff, and they're just having a hard time getting there.
Uh, I hope they figure it out. They're a big bunch of big box stores.
They are. So they got to get back to growth mode one way or another.
Yep. What else have we got?
All right, so the other one we got is a home builder, Toll Brothers. They had a really good quarter, Dave. They beat on earnings, they beat on revenue. They topped expectations across the board. Doing well this morning. They're up 2.33%. And then
It's interesting. The lines of business that I don't expect to be doing well are doing well. The ones that I'd expect to do well aren't. The whole world's upside down, isn't it?
it is another retailer, Carter's. The children's clothing company.
Mm-hmm.
Um, they they had a rough quarter. They big deal though for them. They reduced their dividend from
Ooh.
80 cents to 25 cents a share. That's a
I'm
big drop.
I'm going to
Um,
bet that's going to cause a little selling. What do you think?
it is, Dave. They're down 7.4% this morning.
Stockholders ain't happy with that, even if they are doing well, right?
No, they are not. And we continue to see United Healthcare have issues. Got downgraded by HSBC. I saw another article said that they've been rebating hospitals to kick patients out quicker. I'm not sure where all that falls, but they're getting slammed this morning again, down 4.5%.
Oh, geez, and that's not helping the Dow, I'm sure. Resetting the table, it was kind of a negative day on Wall Street yesterday. The small caps did okay, though. 45 minutes before we opened this morning, what are we looking at?
It's a lot of red ink on the index side, Dave. The Dow's down almost 0.9%. S&P 500 is down a little over 0.6%, and the Nasdaq 100 is getting close to being down 0.7. Big loser, obviously, is the Russell 2000 right now, down almost 1.1%. So a lot of red ink on that side. On the other side, we see some big gains in green. We've got silver up a little over 0.5% to $33.35 an ounce. Gold up 0.6 to $3,305 an ounce. Well, crude oil's right there with it, Dave. Up almost 1.4%, $62.88. That's about a dollar and 20, 30 more than what it was yesterday.
Yeah, not what I had in mind, that's for sure. I need to fill up with gas later this week. Across the ponds on the Asian side of the fence, they tend to look at things as being a zero-sum game. We have a crummy day, they have a good day. The mainland Chinese markets were uniformly up, and the overall Asian index is, for the most part, all positive. Japan was off by a little bit on internal efforts. Europe, on the other hand, is saying, they'll get through it all right. Average European index up by about a quarter. Well, I'm sorry, down now by about 0.25%. Something turned. It just updated. Down by about 0.25% across the board halfway through the European trading day. Something weird happened. I haven't seen a full 0.5% swing when my screen updates that fast in my life. But yeah, they're down a little bit in Europe right now. 45 minutes to go before we start trading on the equities markets. When does the bond market start? I think the auction starts at noon or something, doesn't it?
I don't know. I haven't seen that number come across my tape here, but
Not
we'll be
not
watching the
something I'm
bonds
used to
today.
watching. Yeah, we'll
Yeah,
find out in the
exactly.
morning. Somebody wants to get a retirement on track so that you can retire the way you planned on. That takes a set of eyes to plan things out with a lot of factors in mind. How do I get a hold of you to get a hold of those factors?
Dave, that's why I created the Core Retirement Design to help people design that retirement they always dreamed of. They can give us a call at 863-382-0037 to schedule their core retirement analysis. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk, 7:30 a.m. and 95.3 FM.
And back here tomorrow morning with a look at what's likely to affect your money tomorrow here. I'll see you then, sir.
All right, buddy. Have a great day.
Thank you. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Hey, folks, again, I want to thank you for joining us. Hope your week's going well. I look forward to speaking to you again tomorrow. Until then, take care. Bye now.